Okay, just a quick market update this morning. I want to take a look at some news, some things that are kind of moving the market this morning. Just want to remind you to keep an eye on the Treasury bond market this week. The Treasury plans to raise $100 billion this week. They'll be selling $40 billion of 2-year notes, $35 billion of 5-year bonds, and $25 billion of 7-year notes. Now, that's a big slug for a market that has been less robust over the past few weeks. There's little doubt that all the debt will be sold. The question is, at what price? Now, I did touch on the fact that the government could suffer a bond market dislocation. If the government were to be cut off from deficit spending from a bond market dislocation, I wouldn't put it past them to seize your 401k or your IRA. They would put it under the Social Security umbrella, and you would receive Treasury bonds of equal value. Now, some of you are saying, no way. People would protest and civil unrest would break out. Maybe. It all depends on how they package and sell it to the American people. You see, right now, people are not getting much of a return on their investment for having their money sit in the bank or in a market that's been trading sideways. If the government promised to pay you, say, 5 or 6% interest and would allow you to opt out after 6 months, I doubt we would see much resistance. Of course, this is nothing more than them getting a foot in the door. So, like I said, that would be an option, and I wouldn't put it past them. So, let's take a look at what's moving the market this morning. Why consumer confidence, of course. A preliminary report on consumer sentiment in May is expected to show further improvement in Americans' mood amid tentative signs that the economy is stabilizing. Consumer sentiment zoomed past economists' expectations to 39.2 in April from a revised 26.9 in March. That was the highest reading since November's 44.7, though the numbers are still at historic lows. Still, the index, compiled from a survey of 5,000 U.S. households, is expected to be below the 58.1% reading a year ago. A healthy reading is at least 100. Economists closely monitor consumer confidence because consumer spending accounts for more than 2/3 of economic activity. Again, where is this disposable income coming from in this environment? I'll tell you where I think it's coming from. It's coming from people that haven't been paying their mortgages. Part of it is increased disposable income from mortgage modifications. So, for instance, if somebody was paying $2,000 a month on their mortgage and they had a loan modification and now they're paying $1,400 a month, what are people going to do? They're going to go out and they're going to spend that money. As soon as they get 2 dimes to rub together, they're going to go out shopping again. Okay, this won't last for long. All right, also let's take a look. S&P, home prices fall by a record 19.1% in the first quarter. Home prices fell at the fastest annual rate on record in the first quarter, but the pace of month-to-month declines continues to slow. The closely watched housing index showed Tuesday. The Standard & Poor's Case-Shiller National Home Price Index reported home prices tumbled by 19.1% in the first quarter, the most in its 21-year history. We see no evidence that a recovery in home prices has begun, said David Blitzer, chairman of the S&P Index Committee. All 20 cities showed monthly and annual price declines, with 9 setting annual records. 15 cities posted double-digit drops, and 3 cities, Phoenix, Las Vegas, and San Francisco, all recorded declines by more than 30%. So, how well is the government's attempt to stop falling housing prices working? Not too good. So anyway, again, just kind of keep an eye on the bond market. Just wanted to do a quick little summary and give you guys a little bit of food for thought. All right, thanks for watching, and I look forward to your comments.